Liz, do you think the Fed might derail things this week?
I don't think they're going to derail things this week. I mean, we've got a pretty calm market. We have a market that stopped challenging the Fed, and it started to actually believe what the Fed was saying, that we're going to wait and see if it's actually transitory, and we're going to see what happens later in the year. I think fall is when we have to start digesting maybe some new Fed narrative. But what I think the market is going to start looking for from the Fed is a more clear roadmap. So when should we start expecting a taper? When should we start expecting a rate rise? We get a new dot plot this week, so that should give us some more clarity. But at this point, I think the market is on the Fed side, and I think it's going to continue to be calm waters and a little bit of a sideways grind through summer.
So does your view on some of these mega cap tech that drove the NASDAQ to a record high, Delano, have to be about inflation to have a view about how much exposure do you want to have to big cap tech and therefore the 10-year yield? Because that's been a big swing factor and what's caused the NASDAQ's outperformance over the last few weeks. The 10-year yield went from the high 170s down to 150 or below.
Yes, Sarah, I would think that's part of it, but not all of it. As Mike mentioned, the mega cap and tech stocks have actually become cheaper, and the value's been cheaper for a lot of these companies that had a strong earnings print, and they didn't really move from that first quarter earnings print, right? And they were kind of sideways. And so part of that equation is what rates do and what the Fed says, but the other part of that equation is a lot of these companies that are performing really strong and have great earnings haven't moved for a while, and now you're seeing that move forward because they're relatively cheap compared to what we saw maybe a year ago. So I think that's the other part of that equation.
Mike, banks today suffering. It was off the back of obviously some soft NII guidance. I mean, put another way, it was almost like a delayed response to yields pulling back again last week.
It was almost as if you needed that articulation of what the impact was on a bank's books before you got there. Very interesting, though, because you did see yields up a little bit today. So it's almost as if the inverse relationship between big growth stocks and banks is stronger than the relationship between the yields and either of those sectors.
Although over time they have tracked.
Yes, and we're talking about because yields are already so compressed.
Yeah, and a bit, but again, we've talked about that with the Fed, that given yields have pulled back so much, the scope for them to say something that moves them higher this week is probably more significant than lower.
One would think, yeah, absolutely.
Liz, I was just going to ask you for your take on the bond move and how much you think that's a defining feature of what's happening in the equity market right now.
Yeah, I mean, honestly, I find the bond move a little bit baffling. I think a rally in the Treasury of this magnitude is a lot in the face of higher inflation, even if these hot inflation prints are transitory. I think we do end up at a higher level of inflation than we were at pre-pandemic, because we're going to have wage increases, we're going to have more money moving throughout the economy, which is what creates inflation. So I think the Treasury does have some risk here, especially yields to the upside. And I think that that's probably the biggest risk as we move through the week and hear what the Fed has to say.
Shepard Smith here. Thanks for watching CNBC on YouTube.